Assalamu alaikum friends, welcome to question 14 of SBR. Okay, so question 14 of SBR is based on cash flow statements. So now let us go through the requirements. As you can see, you have been given the draft financial statements relate to Angel, a public limited company. Okay, you have been given the full statement of financial position, and you have been given the profit and loss and other components of income. Okay, and you have been given the statement of changes in equity. So the good thing about this is if you are given statement of financial position, statement of cash flows. So what I've seen is these questions are easier to finish. You can finish it usually within time because most of the information like this are figures. You don't have to read this. Okay. For example, as you can see, I can just scroll over this things. Okay, because these are just figures I need it when I'm doing my calculations. So what I have to read is you have been given some notes here because this relates to the financial statements 1 2 3 4 5 6 7 and then we have this thing. So before I go through the notes, okay, let us read the requirements first because I have this habit in me that I always go through the requirements first. I want you also to install this habit in you that you first start reading by requirements. Start reading requirements first so that when you go through the case study, you know what I'm looking for and it saves time. First requirement is 25 marks. Prepare a consolidated statement of cash flows using the indirect method for the Angel Group for the year ended in accordance with the requirements of IS 7. Notes to the statement of cash flows are not required. One of the easiest questions, right? I would love it if I would have given such questions, right? Unluckily, during my time, I didn't get such easy questions. My paper was a very tough paper, right? I have IFRS 9, then I have so many other things which I was not so okay with. But Alhamdulillah, the good thing is even with that tough paper, I managed to pass with 70%, right? Next one is 5 marks. The directors of Angel have deposited funds with the bank in two accounts as follows. Okay, so out of these two accounts, what you have to do is you have to advise Angel whether each of the fund meets the definition of cash equivalents or not. For you to know whether it meets the definition, you should know the definition of cash equivalent. Okay, that's why when you are going through SBR concept, I would say that please uh, go through the definitions. Okay, memorize the definitions because it's very important. And it's only for 5 months. Okay, so let us go through these points first. The first point is on. Okay, just let me look at the date when you have to make the statement of cash flow for which year. It is for 30th November 2003. Okay. On 1st of December 2002, Angel required all of the shares in equity for 30 million. All of the share means 100%. Okay. So don't go keep on breaking your head how many shares, how many shares. It is 100%. All share capital means 100%, right? For 30 million. Carrying amount of the identifiable net assets in the individual financial statements of the fabulous are set out below. Okay. Together with the tax base, goodwill arising on the acquisition is not deductible for tax purpose. You cannot deduct this from, okay, when you are taking goodwill on acquisition. There were no other acquisitions in the period, tax rate is 30%. You have been given the year-end balances, okay, the carrying amount, the tax base and the fair value. This excludes the deferred taxation. Okay, because definitely when you're taking net assets and all, carrying amount and all, you have to take the deferred taxation, deferred tax asset or deferred tax liability. Okay, so here if you see the carrying amount, it takes deferred tax liability. Okay, but in the fair value adjustments they didn't take, they excluded the deferred taxation. Okay, then second one we have retirement benefit is classified as non-current liability in the statement of financial position. Next we have the benefits paid by, so these are the benefits paid by the trustee. Period by the trust of the scheme was 6 million. Angel had included the obligation assumed on the purchase of suite in current service cost. So they included the 6 million where, assuming that is an obligation, in the current service cost above. That means you have to take this out of the current service cost. Although the charge to admin were correct in the statement of profit and loss and other comprehensive income. So charge to admin is correct. Not able to charge to admin was correct in the statement of profit and loss and other comprehensive income. Therefore, there were no tax implications regarding the retirement benefit obligation. Defined benefit costs are included in the admin expenses. Where is it included? Admin expenses. And also, no taxes there for retirement benefit obligation. Okay. Third, PPE has a carrying amount. This is for you to find the purchase or the disposal of PP, how much you received or how much you paid. Okay, 49 is the carrying amount. Disposed for cash proceeds 60 million. What is the gain? It is gain is then the admin expenses. Depreciation is 29. Purchase 30% interest in associate for cash. Okay, it's an associate. What is the net asset? 280 million at the date of acquisition. They made a profit after tax 40 million and paid a dividend of 10 million out of the profit. Angel does not hold investment in any other associate entities. Impairment test has been done. Show that goodwill and other intangible assets were impaired. Okay, the moment they say were impaired means you have to calculate the impairment. If they say there it has not been impaired, then thank God you don't have to calculate the impairment. Okay, so the impairment of goodwill, that impairment of goodwill relates to 100% owned subsidiaries. Okay, the following schedule release, because see, the impairment could be related to asset also, so clearly they have mentioned that impairment is for the goodwill. Okay, because they told impairment is there for other intangible assets also, goodwill also, but the impairment is for the goodwill, not the other intangible assets. Okay, now we have the financial assets. Next we have, when we are selling the financial asset, this is we are getting 40. Profit on the sale of that financial asset is included within other income, and finance costs were all paid in cash. Okay, the finance cost. So now, before you even start attempting this question, this is a full-fledged cash flow statement that you have to make. Okay, starting from operating, investing, and financing activities, and then you have to balance it. But in the exam, usually, okay, such type of question is not asked now. Maybe this is a very old past paper. I don't know which year, but they don't ask. But this is a good question for you to do if you want to, like when you're practicing. It's good because first of all, you can see your speed. How many of calculations can you do in the time limit given to you? And also, it's a good thing for consolidation purpose. Are you able to consolidate and make a full cash flow statement? See, if you can make a full cash flow statement, how do you do questions on cash flow statement? First question, okay. First step is always start doing by full cash flow statement first. Okay. Then slowly you go towards extract, because if you can make a full cash flow statement and make it balanced, then obviously you can make extracts also, right? It's like first practice the tough things, the bigger things, the major things, and smaller things becomes easier for you. It's like that. Practice that. Okay. So this is a good question, even though this question will not come in the exam. A full-fledged question will not come. Usually they will give extracts. Starts from operating activity, investing or financing. They give questions like this. Okay. In the very beginning they have told in the under the tutorial note. So now you start. Usually the points are given for you to adjust your profit before tax and also for the cash flow statement to include. Okay. So I'm sure most of you might have problems in the deferred tax component, right? If you go through this, all the following information, before you attempt this question, I will like to take you through one thing. Identify. Identify what? Identify which standard. How many standards are used in this question? Even this cash flow statement, IS 7, okay, understood. Even then, there are so many other standards. It's like a combination of many standards asked in one single question. Okay. So if you go through this retirement benefit, right? This is IS 19. Then we have PPE, property, plant and equipment, IS 16. Even though you don't have to use IS 16 here, because it's just that how much you have purchased the property, plant and equipment, that amount you need to find out. Then we have associate. Okay, so associate is IS 28. Impairment test. Impairment is IS 36. Then we have financial asset, which is IFRS 9. Okay, so how many standards? 1, 2, 3, 4, 5, right? And IS 16 also, 12 also, sorry, the for the deferred tax. Then we have IS 7 also for statement of cash flow. So how many standards? 1, 2, 3, 4, 5, 6, 7. 7 standards are used in one question, right? It's not a joke. You need to prepare well for all the standards to do even one question properly. Now let's start with part A. Part A is mostly calculations. So this because no narratives are required, so this will solve a lot of time. Okay, this is very easy. Statement of cash flow, you start with the heading. Statement of cash flow for which year? 30th November 2003. Then starting position, because indirect method, profit before tax. Profit before tax is given to you here. We can check the statement of profit and loss, 188. Okay, we can take as it is. And don't mind me because I have to keep on going up and down between. I have to switch between the question and the answer to show you how those figures we got those figure. Okay, so this is done. Next we have to adjust for the operating activities. Okay, adjustment to the operating activities. All this addition and deduction. Okay, all these are what? Adjustments. Okay, till here. 1, 2, 3, 4, 5, 6, 7 adjustments are there just for profit before tax, after profit before tax. Okay, so starting with finance cost, because finance, see, always start with the easiest thing where workings are not required, where directly you can take from the question as it is. You pick those fast so you can collect marks also in case you at the end you miss out the time, you're short of time. At least the easiest one you might get marks because you wrote it first, right? So start with the finance cost. Finance cost is 11. It is there in your profit and loss account, this finance cost. Okay, this 11, and it is cash. There is no change to finance cost because it is fully paid in cash. The last point says that, so 11 you need to add it back. Okay, then we have the associates profit, which is 12. Associates profit is to be deducted. Okay, same from there only. Wait, associates profit is given here. Yes, this 12. Okay, this 12 you need to deduct it. So this is also deducted. Depreciation is given in the information below, which is 29. You add it. Financial asset. Okay, on the financial asset, what you are taking the profit, that profit on the sale you need to deduct. Okay, because profit deduct, expenses you add. Because what are you doing is you are basically changing the profit before tax into a cash figure. That's why the non-cash expenses you are adding it back. Okay, and non-cash income you are deducting it. That's what you are doing. That's why all these adjustments. So financial asset 40 minus 26, they have shown how they have got that profit. Okay, we'll see. So the financial asset part is IFRS 9. So if you see the sale proceed, it has been sold for 40. Okay, but profit is there in the other income. This is the sale proceed. So we have to go up and check other income. Okay, you have to see other income. Other income is 30. It's given here. 30 is the other income. Okay, therefore, sorry, it's 40 minus 26. It's not 30. 26, 40 is the sale process minus 26. Okay, Okay, so that we are taking from how much is this other income is 30. Okay, let us read that part again. Financial asset, okay, is 40. So 40 minus 26, okay, you need to find out 26, the carrying amount of the financial asset. Profit is included in other income and you have sold it for 40. So if you go through other income, other income, it is 30. Okay, the profit is written 30. So profit is 30 means, if you see here, okay, this is 4, right? For the financial asset, items that may be reclassified to profit and loss account is 4, right? So this is 4, then it should be plus 26. That's how you are getting 30, because the total profit will be recorded there. Okay, it is 30 minus 4, that's why you are getting 26. You understanding? This is 30, this amount. Other income, it is 30. Okay, so from that 30, you are deducting 4 to find out the profit for financial asset. This is under OCI. You want to find in the profit. So from the 30 other income, you are deducting 4, which goes in the other comprehensive income. 26 goes in the profit and loss account. Okay, we want what goes in the profit and loss account. We are not taking care of OCI right now. So that's why we are deducting that to find out 26. That's why we are deducting 40 minus 26. 40 is the sale proceed, 26 what goes in the profit. Okay, profit on sale. Because out of 30, 4 goes in OCI, so the balance 26 is for profit on sale. This needs to be deducted. Then we have profit on sale of PPE, 63 minus 49. Okay, okay, just give me a few minutes, guys. I'm sorry for this. I just need to reply a message. Okay, sorry guys. Profit on sale of PP is 63 minus 49. So profit on sale of PP, we need to go to the other info. Most of the things you will get from the other information only. Okay, since I have written the standards next to it, so I know point number 3 is for property, plant and equipment. Cash proceed is 63 and carrying amount is 49. 63 minus 49 is the profit. It's very easy. Okay, so 63 minus 4. Wherever no working is required, you can just explain it through one line like this. Next to it only you can write it. No need to show working 1 and 2. So 14 you need to deduct. Then we have impairment of goodwill and intangible assets. For that, working 2 is required, which needs to be added. Okay, impairment we add. Retirement benefit expense, it's an expense, we add it again, and for that we have working 6. Okay, basically all the expenses and income we are adjusting here. So then we have, before we go to this workings, I will definitely take you through this working 2 and 6, but before that let us go through the movement in working capital, because this is something easy and I can quickly finish it also. So trade receivable, we need to go to the statement of financial position. Okay, if you go through here, you can see inventories. Wait, this is which one is the earlier year, 2023. Okay, you can see inventories is declining, trade receivable is declining, payable is down. Payables are increasing, I guess. No. It is also decreasing. All the three are decreasing. But you need to know whether it's an inflow and outflow. Okay. You need to write decrease in trade receivable, decrease in trade receivable, decrease. This word you need to write whether increase or decrease. Okay. So you need to show it also the difference. If trade receivable decrease is an inflow because your customers are paying you, that's why receivables are reducing. If inventories are reducing, it's good, you're not buying inventories, so it's an inflow. Trade payables is reducing, it's an outflow because that means you are paying your supplier. That's why your trade payables are reducing, so 210. It's an outflow. One additional thing is there. This one minus 66, 3 minus 6 minus 4. This additional adjustment is there for consolidation purpose. Why are we deducting it? And what is it? From here, when you have been given the here, you see, you need to take this amount, the fair value, when you're taking the year-end balances for the angel group. Okay, it is in the angels group. That means the subsidiaries portion is also here. The sweeties proportion is also here. This needs to be deducted because this is an accusation. Under accusation, I have told you, you can go and check on my IS7 videos. Deduct. When it's an accusation, you deduct their net assets. When it's a disposal, you add. No matter whether receivable, payable, or inventory, you deduct because it's an accusation. So here you are taking 6, you are taking 3, and you are taking 4. 6, 3, and 4. You need to deduct. Okay, so that's what we are doing. 6, 3, and 4. The fair values we are taking, not the carrying value or the tax base. Okay, you deduct it. Then we get the item which we get, please label it properly. You will get marks for writing this proper heading. Okay, cash generated from operations. From here, you need to deduct 3 things. One is interest paid, one is tax paid. This we know. Next new thing here you're learning is cash paid to retirement benefit scheme. For that, working 6 is there. Okay. Then the amount which you get is known. It is very small amount, as you can see. It is net cash generated from operating activities. Okay, it's a positive figure. But before we go to the investing activity, let me go through the ones which I missed out. Impairment of goodwill, working 2, retirement benefit expense working 6, and income tax paid working 5. Okay, so working 2, 5, and 6. 2 is impairment. Please label like this if it's impairment. Okay. Next. So how do you do that? The starting place is opening and closing balance. Okay, you start with opening balance, you end with the closing balance. Opening balance will be at 1st December, closing balance will be 30th November 2003. Okay. Then impairment is usually the balancing figure. Then we have the current year amount on subsidiary. What is the current on subsidiary? For that we need working 3. Under the working we need another working. Okay. Which is 11.5. First we'll see the opening and the closing balance. Okay. What is this opening and closing balance? This is the goodwill balance. Okay, you have to reconcile the goodwill balance to find the impairment charge. 120. If you go to your statement of financial position, you will see the goodwill amount is there. 120 versus 105. So goodwill has 120 and 105 is the closing balance. Okay. Then we have the current year amount on subsidiary. Working 3, 11.5. Okay. So let us go to working 3. For that we need working 3. purchase of subsidiary. Okay. Calculation of deferred tax arising on acquisition. Mm, okay. The question is why deferred tax you need when you're calculating acquisition. Because you are calculating net asset. Why you are calculating net asset? Because if you don't calculate net asset, how will you calculate goodwill? You see down, you need goodwill arising on acquisition, basically. It's not given to us. We need to calculate goodwill when we have purchased the subsidiary. So to calculate that goodwill, we need net assets, purchase consideration, and uh, NCI, right? But here the NCI, they have not mentioned how much is the NCI, so you don't have to worry about it. Okay. So I'm sorry, I think they have purchased an associate or a subsidiary. We have to see how much percentage they have. Kind of little confused. I'm sorry. They have angel purchase an associate for cash. Okay, and first they have purchased all of the share capital. Okay, okay. It's also subsidiary quality because they have not given anything related to NCI. So I was a little worried that maybe it's an associate, but then associate you cannot consolidate. So yeah. Okay. Because you see this is what happened. Okay, this is what happens to most of you also. You are so memorizing calculation of goodwill, purchase consideration plus fair value of net asset, sorry, fair value of NCI minus fair value of net assets. So I was looking for that NCI, it's not there. So if it's not there, then it's just purchase consideration minus fair value of net assets. In the net assets we need deferred taxation. Remember, in the fair value of net assets, deferred taxation was excluded, so that you need to include for you to calculate goodwill arising on acquisition, because you have to add this with opening balance, then you compare with the closing balance, then that the difference is impairment, which we need for working too. So that's why first we have to find the deferred tax arising on acquisition. Okay, what is the fair value to calculate that? Okay, deferred tax. Remember, to calculate deferred tax, what should you do? What is the starting point? I have recently uploaded a video on ICE 12. Okay, so tell me, deferred tax is based on what? What do you need to calculate in order to find deferred tax? Number one, difference between the carrying amount and the tax base. That carrying amount should be the fair value, okay? Fair value of the suite is identifiable net assets excluding the deferred tax, less tax base. First, you need to find the temporary difference. This is the number one thing. Find temporary difference, because on that only you will apply the percentage of tax and you will get the deferred tax. Liability or an asset, you have to see. You cannot tell from before whether it's an asset or a liability. Okay, so you are starting with the fair value, which is 20, less tax base, which is 15. Okay, we need that table for that. This one, if you see the deferred tax, wait, it's 20 and okay, wait, just wait a minute. Okay, so if you see the net assets at acquisition, it is 20 here. This have already excluded the deferred taxation. So 20 minus tax base is 15. You see, so 20 minus 15. So that 20 minus 15 is your 5. 5 is a temporary difference. 5 is a positive figure. So on that you have to apply 30% because tax rate is 30%. Okay, so 30% on 5 is 1.5. This is your deferred tax liability. Please mention it. It is a net deferred tax liability. Now you have 1.5. So what else? Take the purchase consideration minus fair value of net assets plus deferred taxation. So fair value, you have the purchase consideration is 30 million. You have bought it for 30 million. Okay, fair value of net assets net of deferred tax is 20. Okay, no deferred tax has been included here. Okay, 20. It is the fair value of net asset. Now you are taking deferred tax. Why you are adding? Why you are deducting and adding 1.5? Please explain me this. Why it is an addition? Because most of the people, what they will do, they will go and minus 1.5. They will show 1.5 in the bracket. This needs to be understood. Why you are adding? See, deferred taxation, when you're putting in the net assets, okay, you deduct from net assets. You're taking in, it's like 20. This is a very annoying thing. 20 minus 1.5. Okay, 20 minus 1.5. That's what you do, because deferred taxation is a liability. It falls under liability. Assets minus liability. So net asset, if your liability increases, your net asset will reduce. So it's 20 minus 1.5. Hence, it will be 18.5, isn't it? So because this figure is already in bracket 20, and if you put bracket here also, it will be an addition. It will be 21.5, not 18.5. So that's why, to show that it's a deduction, this is in bracket. This you have to put without bracket 1.5. Then when you put it in a calculator, minus 20 plus 1.5, it will show you 18.5 only. Okay. It's basically your knowledge of maths you need, in which sign you need. Okay, because this is the formula, fair value of net assets you deduct. You cannot put a plus figure here. Plus 20 minus 1.5. Then this number will increase. This has to be in bracket only, fair value of net assets. So this needs to be given in positive. Okay, it is net of deferred tax. Don't, so when, another way a candidate might say that why not take 20 and deduct 1.5 and take 18.5 here only and deduct that only from 30, because the result is same. You will get 11.5 only. You cannot do that. You cannot net it off like that. You have to show it separately as like this, a separate item. You will get marks for it. You cannot put it under the fair value of net assets and then deduct it. Maybe you can do, but that marks you will not get when you show it separately. It's better to show it separately like this. It's always safe to do it. Whenever such things is there where you have the chance to net it off or show it separately, show it separately. Okay. So once we have taken purchase consideration, I kind of forgot. We'll see that. Definitely will be the first paragraph. Right? Yes, they have bought it for 30 million. Okay. So this is the goodwill 11.5. Okay. So hence this goodwill now you can use here. You can see this goodwill 11.5. Then 120 plus 11.5 minus 105, the balance is the impairment 26.5. Okay. Now what is next? These two lines. Okay. Impairment of other intangible amounts and total impairment. Okay, total impairment, basically you are adding this 90 with this 26.5 impairment from goodwill, and this is the total impairment 116.5. So if you see in your cash flow statement, you will get 116.5. You can show it separately also, impairment of goodwill plus impairment of intangible assets, or show it together like this. But if you're showing it together in the working, it should be shown that how you are adding the two figure. Okay. Next, we have the impairment of other intangible assets. How do you get the impairment of other intangible assets? Very simple. Just look at the statement of financial position and compare the two figures. When you go to the intangible asset under non-current asset, here 240 minus 150, right? 240 minus 150. The balance is the impairment. Okay. But for goodwill, you cannot do like that. The difference only. You have to add the goodwill which you have acquired when you have acquired the subsidiary. That's why we calculated this 11.5 over here. Okay, that is one additional thing in goodwill. But in impairment, just take the balance between the two opening and the closing figure. The balance is the impairment. Okay. Now next working is working 5. So we are done with working 2, 3, 4 is for associate, we'll do it later. First we'll go through taxation. Working 5, because this also needs to be deducted from operating activity. Okay. So taxation, how do you start taxation with? You should be a pro at taxation by now, by the way, because this always keeps coming. So you start the same, okay? Opening and closing, opening and closing. That's the good thing about cash flow statement. Mostly it's about opening and closing balance. You compare the difference and some adjustments in between, and the balance is the cash flow, cash paid or cash received. Okay? So you start with the opening balance, and this is the closing balance. What do? Add both the income tax and the deferred tax. Income tax and the deferred tax. We'll go to this statement of financial position. Okay, if you go under your it is under your non-current liabilities. Okay, one is deferred tax, this is 31. One is your current tax payable, so you add this with this opening balance and you add this with this. Remember, taxation, there is only one working for taxation, no two separate working. Deferred tax versus your income tax or current tax, if together you add and show as taxation. Okay, so you add here also. Okay, opening and closing. Next, what is next? For deferred tax on acquisition, we just calculated 1.5 working 3. When you acquire, there's a deferred tax on that needs to be added. What is the charge? Okay, whatever the amount goes in the profit and loss account, that needs to be added with the opening balance 46. That you will get from this here, this income tax. Okay, this income tax. Next, what we have a deferred tax for tax relating to items not reclassified, which is 2. Okay, tax relating to items that will be classified, which is 1. So 2 and 1. Okay, so we can take 2 and 1. Okay, when you take 2 and 1, don't just write tax, write it is tax on what. You cannot take it charge for the P&L or tax on the profit and loss account. No, it comes from OCI, no? So you have to write it is tax on which item? Revaluation, PP, and financial asset. Okay, so the balance is your cash paid. Okay, so negative figure is cash paid. Definitely will be cash paid only. You will not receive cash. So this is the tax paid. And working 6. We need to go to working 6 to deduct this also, retirement benefit. How much in cash we are paying? Do we have working 7 also? No, that is the last working. Okay, so service cost component and net interest are non-cash expenses. You need to understand this. They are non-cash, so they must be added back to profit. Okay, so what are you doing? Retirement benefit, opening versus closing balance. Always the opening and the closing balance of any item, whether it's an income or an expense or an asset or a liability, you will get it definitely asset at a liability only, not income and expense. You will get from the statement of financial position only. Okay, so 74 and 80, we have to see the retirement benefit in the statement of financial position. Okay, so if you see here, retirement benefit liability, we have 74 versus 80. These are the opening and the closing balance. Okay, 74 and 80. Then we have from the profit and loss account in between. It's always like that. Opening and the closing balance you will get from the statement of financial position of any item. In between balances, what you have are from your profit and loss account or OCI. Okay, or something which is given in other information. Then always the balance is your cash paid or received. Okay, remeasurement component. So remeasurement component for that retirement benefit you have to add current service plus interest also you have to add. So the balance is contribution paid, which is 9. Basically, you are finding this figure only. How much contribution you have paid. That means in cash only you have paid 9, right? We'll find out the 4 and 7, okay? 4 and 7 from where you got. You have to go to OCI to get the remeasurement component. Okay? So here, if you see, actuarial losses on defined benefit plan, this 4 you are taking. Okay? Then what is the other part you are taking? One is, you are taking this one. Remeasurement component 4, current service cost plus interest. Current service cost is 11. We have to read for that in the other information. Here, note number 2. So current service cost, contribution to scheme already they have given 9. Okay? And you are adding the net interest cost with the current service cost. Okay? So 3 plus 8, 11. Okay? So 11, contribution paid is already given. Okay? Now, you must be wondering what is to do with cash here. Okay? So you read this. The 11 million service cost and the interest figure above including the carrying amount of the subsidy defined benefit obligation at the acquisition date. Okay? Therefore, the actual expense is 10 million. What is actual expense? 10 million. This is added back in the reconciliation between profit before tax and cash generated from operation. 10 million is added in the cash flow statement. Why? How? It is 10 minus 1. 11 minus 1, 10. That is actual expense. How? We have to go to that reconciliation process. Okay? If you see here in the subsidiaries net asset, okay, carrying amount is 1. So is the fair value. Okay? So that 1 you need to deduct. That is the actual amount that will go in the profit and loss account. 11 minus 1. Okay? 10. So now we are over with all the workings for the operating activity. Now let us go to the statement of financial position and see it. Right? So interest paid is 11. Okay? Then income taxes, we have done the workings. And then we have to deduct the cash paid. So that is that one is here. Okay? That retirement benefit scheme 10 is here. We are taking it. We have to add it back. But when we are deducting cash paid to retirement benefit scheme, we are deducting 9. The contribution paid to the scheme. Okay? That 9 only we are deducting. Is already given. Next, we are going to the investing activities. Okay, under investing activities also we have plenty of things to do. Sale of financial asset, purchase of financial assets. So sale definitely inflow, add, purchase you deduct. So for purchase of, let us first finish with the working stuff, right? That's what I feel is easier, so that we can quickly fill the balance. Okay, working one, property, plant, and equipment, how much you have purchased. And then we have working one for the dividend you have received from associate, and also how much you have purchased the associate. So first we'll go through working 1 and 4 and finish it off. Okay, so working 1 also statement of financial position. When you go, you will see the opening balance and the closing balance given to you. Okay, you have disposed 49. They have already given in the this one that you have disposed 49, and depreciation you have to deduct. Revaluation is 8. Okay, and acquisition of subsidiary. The balancing figure is usually the cash flow. Okay, acquisition of subsidiary is 14 and revaluation is 8. We'll go through this two figure. Okay, 8 and 14. Revaluation is 8. How do you know revaluation is 8? Because from the profit and loss, revaluation of property, plant and equipment. This 8. This is why you need to have a critical eye. You need to look at each and everything. Are you missing out anything or not? It's easy that you forget this. Okay, 8. Then we have, what is it? After evaluation, we have acquisition of subsidiary, 14. This also needs to be there. When you have acquired the subsidiary, remember their property, plant and equipment also you will take. Okay, so there it is given in their account. You see here, this 14. Okay, you are taking the fair value. So 14. Next is, sorry, this is taxation. So the balance is your purchase. Okay, with working 1 we are over. We are working with working 2 also. 3 also we are over. 4 is associate. 5 is also over. So this is the last working. Associates we use equity method. Okay, balance is nil. They didn't give any balance for associate. Closing is 80. This you can see from the statement of financial position. Profit for the year, you can see the associates profit. And then, so cost of acquisition, how much you have, how much it cost you to buy the associate. This is the balancing figure. Okay, that means we have to work out the dividend received. Okay, associate was 30% and dividend was 10 million. So out of that 10 million, you all remember, don't take the full 10 million. Okay, you always have to take the associate proportion, 30% of that dividend. 3 you need to deduct it and you will get. Okay, so the cash paid for the investment is 71 and cash dividend is 3 million. Now we can go and finish the rest of the cash flow statement. Okay, sale of financial asset. You have, so it is given in the other information that you have sold the financial asset for 40. You have purchased financial asset for 57. How can you say 57? Okay, just go to the financial asset. Or maybe they have given somewhere relating to financial asset. IFRS 9, it is the last 40. Okay, so how do you know that it is this thing? For okay, let us go through the two accounts. If you see financial asset is 180 minus 250. If you take the difference, the increase is 35. Okay, because I think a working is required to do to get this purchase of financial asset 57, right? Okay, for time being we'll leave it and we'll go towards the other. Okay, so dividend receive and purchase associate, we have just calculated it. Proceeds from sale of property, plant and equipment, we have sold it for 63, and subsidiary 30 minus 2. Why 30 minus 2? When we purchased the subsidiary, how much we purchased it for? 30 million. We are deducting 2. Where is this 2 coming from? That 2 is coming from here. This one, cash and cash equivalent of the subsidiary. Remember, whenever you acquire a subsidiary, whatever the cash and cash equivalent of the subsidiary, you have to deduct it from your purchase consideration. That's why 30 minus 2, and it will be in the investing activity. Okay, all these rules are there in IS 7 when I explained you. You can go and check my lecture on IS 7. Okay, it's just a repeat. I'm just repeating here so that no one should have a doubt why it is deducted. Hence this is also over, this is also over, this is also over. So the doubt is 57. Okay, next we are moving on to the financing activities. Financing activity is one of the easiest things, so we can just finish off with financing activities, then I will move on to this 57. Okay, dividend paid to NCI. This you will get from statement of changes in equity. This also dividend paid is 10 and 6. Proceeds from issue of share to 25 and repayment of long-term borrowing 26 minus 57. So definitely that statement of changes in equity is there, at least some use you have to make of it, right? So here you can see the dividend is 10, okay, and NCI is 6. And the share capital, how much you have issued? This much you have issued. For mostly for financing activity, you can use this piece of information, okay? So the only thing is so this is over. Dividends paid to NCI is over. This is also over. How much you have issued? Remember how much you have issued, okay? And repayment from long-term borrowing, you will get it from your statement of financial position, okay? When you are taking cash shares, okay, it is this you have to take 205, not 620, not 850, 225 only. For the long-term liability, you have to see this from, it is long-term borrowing you have to see, not the non-current liabilities. No, only the long-term borrowing you are taking, okay? 57 minus 26. Make sure that you do this question again on your own and see whether you're getting the figures, because it's easy to check whether you're right or not. This is calculation, right? So whether you're getting all the figures right or not. So with that, it's a repayment. Repayment means you have to pay, so it's a outflow. Okay. So finally you will get this, and when you take all the three, from all the three activities, when you add your net cash flow from operating, investing and financing, you will get 110. With this is the opening balance you will get from your statement of financial position, and this is your closing balance. It balances, right? You have to get 465 at the end. Let us go to the statement of financial position. Okay, how do you get it? It is in your cash and cash equivalent. You see, this is opening, you add, and you should get this amount, 465. So you know you are right. So the only area which I have missed out, I have finished all. The only area which I have missed out is this one. Purchase of financial asset 57. Okay. So I think for that there's a working. There is no separate working for it. Okay, and neither they showed it. 57. So you have to see whether they have mentioned something or not before we go to the next requirement. Next requirement is easier. That's why I'm taking more time here, because this needs to be correct. Nothing from the other. Yes, you will get from this schedule. 57. You see how many places you have to visit just to get the cash flow statement right. And this takes a lot of time. That's why practice is the key. You need to practice this multiple times until you get it right in the correct in the time limit. 57. Okay. So with that, I have finished the first part, the cash flow statement. Now let us go to the second, where we have to define the cash equivalent, which is for 5 marks. And then we are going to go through the marking scheme as per our tradition. So we are starting by defining cash and cash equivalent comprise cash in hand and deposit. It defines cash in hand, demand deposits, together with short-term liquid investments which are generally readily convertible to a known amount of cash and which are subject to insignificant risk of changes in value. All these things needs to be there. Definition needs to be there as it is. Like certain worth has to be there, like short-term liquid investment is included. Then those which are subject to insignificant risk of changes in value. They do not change in value so much. Even if they change, the value is so small that the risk is very insignificant. The risk is not so much. Okay. So IS7, you need to say what IS7 says. IS7 does not define short term. Do they? They do not define. But does state an investment normally qualifies as a cash equivalent only when it has a short maturity of say 3. So they do not define what is short, but they say that cash equivalent defines, we take it as short term when it is for short maturity. Short maturity means 3 months or less than that from the date of acquisition. Okay. So consequently, equity or other investments which do not have a maturity date are normally excluded from cash equivalent. What are excluded? Equity and other investments that which do not have a maturity date. They do not mention the maturity date. So you cannot say short term. If it was short term, they would have mentioned the maturity date. For example, equity or other investments. Therefore, they are not cash equivalent. Okay, they are excluded from cash equivalent. They are not cash equivalent. Okay, now you need to apply that. Till there, it was your knowledge part, definition part. Now you apply it to the two deposits, whether it will qualify for cash equivalent or it will not qualify for the cash equivalent. Okay, just see how they have divided into first and second deposits. Okay, write your answers like this. It has to be very clear which deposit are you talking about. We didn't read the case study, part B. So let us read. Okay, 3 million into 12-month term account earning 3.5 interest. The cash can be withdrawn by giving 40 days notice, but Angel will incur a penalty being the loss of all the interest earned. It will incur a penalty. That's like a significant risk, isn't it? And also they didn't say anything about maturity. It's for 12-month term account. Okay. Next one is 7 million into 12 months, same, earning 3%. Cash can be withdrawn by giving 21 days notice. Interest will be paid for the period of deposit, but if the money is withdrawn, interest will be at the rate of only 2%, which is equivalent to the bank's stated rate for the short-term deposits. Okay. Angel is confident that it will not need to withdraw the cash from the higher rate deposit within the term, but wants to keep easy access to the remaining 7 million to cover any working cash shortfalls which may arise. That means they might need the second one, this one, 7 million to cover their working capital shortfalls. Okay, she's confident that they might not need the 3 million 12-month term account, the first deposit. Okay, so it looks like that first one will not be classified as cash equivalent. The second one might classify as cash equivalent. We'll see the answer. So although the principal 3 million will be recovered with early withdrawal, yes, you can recover this. The entity will lose all the accumulated interest over the term, which seems to be a significant penalty. The cash is not needed to meet the short-term cash commitments and so will not qualify as cash equivalent. So this cash is not needed for the short term. So it does not qualify as cash equivalent. Second, deposit is 12-month maturity period. It can be withdrawn with 21 days notice. Although this incurs a penalty, the reduction in the rate is only from 32%. Is unlikely to be considered significant. You see, it's very significant. And it's also in line with the bank short-term deposit rate also. All these are from the case study only they are giving. The intention of the management is to keep these funds available for short-term needs, and so the deposit is likely to qualify as cash equivalent because they might need this for the short term. So first one does not qualify as cash equivalent, second one qualifies as cash equivalent. Okay, now let us go to the marking scheme. We have finished question number 14 because the first question is 25 marks. Okay, so second is easy, 1 mark per point, you will get 5 points. Okay, let us go to A. How 25 marks are spread across this thing. Finance cost 1 mark. When you're adjusting, okay, all these are adjustments in your profit and loss account. So finance cost 1 mark. It is as it is. Associates profit also as it is. Depreciation also as it is, no adjustment. Profit on disposal of property, plant and equipment, financial assets as it is. Impairment of intangibles. You need working, that's why it's 2 marks. Impairment of intangible means you are calculating, finding the difference between the opening and the closing balance of intangibles. Pension expense is 1 mark. Then we have working capital movement 3 marks because 1 mark for inventory, 1 mark for receivable, 1 mark for payable. Cash paid to pension is 1 mark again. Interest paid is 1 mark. It's easy. Tax paid is 2 marks because workings are required in tax. Sales and purchase of financial asset is 1 mark. No working is required, is given. The figures are given. Purchase of PP is 2 marks because we need workings. Next we have purchase of subsidiary 1 mark. It's given. The amount is given. Proceeds from PP disposal again 1 mark. Dividend from associate. Purchase of associate. Proceeds from share. Borrowings. Dividend paid to NCI. Net movement in cash. You see each and every item has marks. Okay. Don't worry, even if you're missing the final mark, 1 or 2 marks you miss, maybe your answer might be wrong. Let's say your dividend from associate is wrong figure. So you will get 0, but at least for workings, you might get half. You see, for workings, you will get marks. So don't leave it like that and show workings wherever is possible to get this 25 marks. Okay, so that's it, and see you in the next question, question 14.